Forgot.
Location, location, location. Woo!
I'm Realtor Victor Naraki, and I specialize in homes near Disney World.
Hey, I'm Victor Naraki, and I'm here in this community today on this beautiful June 1st morning. My customers are closing tomorrow. They're not in town, so I am doing the walkthrough. Take a look after this spiffy opening. Stay tuned right after this spiffy opening. Right after this spiffy opening. So you're looking at the house for the very first time.
It is exceeding expectation at the moment.
Wonderful. I'm Realtor Victor Naraki with one of my buyers, Darlene, and she just bought a house near Disney World. And now she can go on the Jungle Cruise anytime she wants, 100 times a year. Same jokes, but 100 times a year. Hey everyone, how are you? So it is Thursday the 14th, and I am Realtor Victor Naraki, and today we're going to talk about buying a home with a lender, and I've got my favorite lender, Todd Affricano, and here he's going to join us. Hey, Todd, how are you?
Hey, Vic, how you doing?
Great. So today we're going to be discussing, if any of you guys have questions, we got a couple of questions came in beforehand, so I'm going to ask those. But when anybody approaches me about buying a home, I always ask, well, are you cash or a loan? If you're a loan, let's find out what your budget is. And someone like Todd is the guy who decides what your budget is. And I always say you got to stay within your budget. When it's amazing to me how many people are told, oh, you could spend up to $2,000 and they will get the one that's $2,000. You could buy a house worth $400,000, and sure enough, 401 is what they go for. So I always say, try to be under it. Really try to be under it. So Todd, how is everything going with you today?
Everything's doing great, Vic. Everything's doing great. And if I could kind of piggyback off of what you just opened up with
Sure.
there, um, you know, I talk to a client or a potential buyer, of course, uh, the first thing I always ask them is, what are you comfortable paying monthly? And that really is going to determine a lot into what purchase price the home should be. If somebody's, comfortable, I'm not even talking about the qualifying part of it, but if somebody's comfortable just paying, $2,500 a month, on their mortgage, that's
Mhm.
what their budget, applies to. And if it's 2,500, well, then you're not going to look for a $600,000 house.
Mhm.
You're going to look for something that would make that mortgage payment around $2,500, which is something in the mid 300s.
Okay.
So that kind of narrows the whole the idea of like what you should kind of look for in a purchase price. You have to have that idea right off the bat. That way the client's not wasting their time. You're not wasting, the realtor's not wasting their time. So you can kind of narrow down that purchase price on that
Yep.
in that.
Sure. Now let me ask you something. I got one of the questions came in was how much does someone need to put down to buy a home? And I know that everybody is different, but give me some different scenarios of how much they would need cash to put down.
Sure. Typically, if it's a primary residence, the home that they're going to live in, you can do 100% financing. Now, when it comes to 100% financing, the interest rates are a little higher because there's not that much skin in the game, so to speak. But first-time home buyers, 3% down. Conventional financing. That is like if their credit scores are really good, you can go conventionally. If they're, let's say, and life gets in the way. We all know that, and let's say there's some things happen where your scores aren't as great as or great to conventional financing. Then we can go FHA financing, which is 3.5% down on a primary residence. If you're looking for like a second home, 10% down. Typically, an investment property is typically around 20% down. Now, we'll say this, Vic, that let's go back to the investment property here real quick. The difference between putting 20% down, that's the guidelines, that's the minimum. But if you're able to put 25, 30% more down, the difference in the interest rate is night and day. All right. So, the more money you put down, your lower your mortgage payment's going to be, obviously, because of lower principal on the loan.
Yeah.
And typically, those are the three. Those are the three: primary, second home, and investment property. But the more you put down, it's going to reflect a lot on what you're paying monthly, not only with the loan amount, but also with the interest rate.
Now, when I'm working with a customer, one of the things that comes up is I never actually look at what their loan is, what their payments are going to be. I'm looking at how much they got to spend. But when you go under 20%, is there still that PMI involved? Because I don't hear about it very often now.
Mm-hmm. Yeah, if you're doing a conventional loan, if you're putting 20% down, anything less than 20% down on a conventional loan, you're going to have what's called the private mortgage insurance. What that does is that just protects the lender in case you default on the loan. Okay.
Sure.
If you're doing an FHA program, the private mortgage insurance will be in place. Pretty much for the life of the loan. After 7 years. It can eventually drop off, but FHA, you're going to have your private mortgage insurance and VA loans. You're not depending if you're exempt, what's called exempt, if you're disabled or that kind of thing. When it comes to a VA loan, you not only do not have to pay the private mortgage insurance, the PMI, but In a lot of cases, you don't even have to pay for the taxes on the home either each month.
Yeah, I have a customer that was he was surprised when he sent me his taxes, and I'm like, I never saw that before. His taxes were literally zero. It was amazing to me. I couldn't believe it. I was
Yeah.
like, wow, there now, but it doesn't cover CDDs, right? When
No.
no, okay. So
No.
CDD fees, for those who are watching, are really an additional tax. It's called not an ad valorem tax, and it's basically to pay for the construction of the community. Maybe it's a clubhouse, maybe it's the piping underneath the whole community. I don't really like them, but if you're actually getting something for it, I don't mind, because it's just like an extra HOA fee. So anyway, so that's the CDD fee. Yeah, let's talk about some of my customers. They're not ready to buy now because they've caused some damage to their credit. Is there anything that buyers can do to help improve their credit?
Certainly. The number one thing is, don't be late on any monthly payments with your credit cards, your card payment, anything like that. That's a big problem. The best thing to do to improve your credit is keep the balance on your credit cards, okay, under 30% of what the maximum limit is. So don't max out your credit cards, but if you keep that balance
Okay,
under 30%, that's the golden threshold, okay, so to speak.
So if your credit limit is 20,000, keep it under 6.
Yeah,
Cool.
exactly.
Okay, I never heard that before.
Also, what you can do is say, like, a lot of these first-time home buyers, they haven't established a lot of credit, okay, yet.
Yes.
If you do have a parent or a family member, a good friend, doesn't really matter. If you can become an authorized signer on their credit card, okay, that will help their actual credit scores go up quite immensely also.
So someone goes an authorized signer on my credit card, that improves my score to get a loan? Really?
That's right. Yes.
Wow.
Let's say, Vic, you have your younger brother, okay, has an established credit, and you, being the great man you are, you say, come on, you can be an authorized signer on my credit card, meaning that they're going to join with you on your credit, okay, your credit card. And if your credit card's already been established for years, let's say, that's only going to help them improve their scores. And it's pretty quick turnaround.
Hey, we got another question that came in. What happens when you get a gift to help pay for your down payment?
Okay, there's many types of gifts. Okay, a lot of people, and that's a great question, Vic, because a lot of people are thinking, how do I don't have any money in my accounts. Okay, you can get a gift from a family member. You can get a gift from your church. You can get a gift from your employer. Okay, these are all basically can take the place of not having to bring your own assets to closing.
Sure.
Okay. So with that being said, let's say that Uncle Bill has done pretty well for himself, and he's going to give you a gift to purchase a home. The only thing he needs to do is fill out a gift letter that we provide as the lender. He fills out with his account information, and that's it. And then at closing on that home, Uncle Bill will just wire that money for the gift straight to the title company.
Cool.
That's as simple as it is. And the gift can be used for down payment, closing costs, anything like that. So, a lot of people are like, I'm kind of dead in the water. I don't have my own money. There's ways to get around that. There's no doubt about it.
And the one thing that was interesting to me, when I bought my first home, my parents gave me a very good chunk of the down payment. And and I didn't understand any of this, but they actually had back then they hand wrote a thing that they were not going to ask me for the money back because that would increase your debt. So the bank wants to know that they're not expecting that money back, right?
Correct. That's There's any type of a loan from somebody that you take out has to be included in your debt to income ratio. Any type of a loan, except a loan off of your 401k. That
Okay.
doesn't have to be in court because that's your money. Okay. But that when it comes down to the gift, that's what it is. It's a gift. Okay. And
Yes.
the gift letter takes it now, whatever you work out in the future with whoever gifts you the money, well, that's your business. You know what I mean? But
Yeah.
it's a gift.
With some of my customers, it is I feel such sympathy for them because I remember when I was buying my first and second home and getting loans to do it. I could not believe how intrusive it is. They actually looked at my bank statements for the last couple of months. And when I was buying this house, and I only got a very small loan for this house, I had to show them every time I had money come in, I had to show them where it was from. And there was like slight discrepancies of $50, and they had to know where it was from. I'm telling you, nothing is more intrusive than getting a loan, except maybe a colonoscopy. Anyway, so now got a question from Diane, and this is a pretty interesting question. Diane is asking, does outstanding medical bills affect your credit score in buying a home?
No, let's say that you have outstanding medical bills, we do not include that. Okay. Medical bills are
That's a
not
surprise
included.
to me. Okay.
Yeah. We're not going to include medical bills. And actually, here in Florida, over the last couple of years, they've instituted where medical bills will be deleted from your credit, report. So, medical bills, no worries there. Now,
wow, that's a surprise.
if you have a surplus of medical bills, will they affect your credit scores? Possibly. It's a case by case thing, but we don't really look at medical bills that closely when it comes down to, applying or qualifying for a mortgage.
Okay.
Mhm.
Now, just to reintroduce Todd, Todd is actually a broker. So you don't work with like one bank. You work with several different providers, would you call them?
That's correct. We work with around 70 wholesale lenders. So what we do is that we're looking for the best lender to put your loan at home with. Okay, what's going to allow you to have the lowest monthly payment, lowest interest rate, lowest monthly payment. There's certain lenders that specialize in certain areas, non-qualifying mortgages, your DSCRs, your bank statement loans, that kind of thing. We weren't going to get into all that. But, what we do is, being a broker, we cut out the middleman, so to speak. We're basically go right to the wholesale lender. So when it comes to interest rates, we're going to have the lowest ones in the market.
Excellent.
And no overlays, meaning if the loan can get done, if the financing can be put in place, we can do it because we have that plethora of lenders to choose from.
Yes, and Florida Man is saying the underwriters asking for stuff right before closing is very stressful. And I tell you, yeah, it is. It is. And with me, they asked me, I remember this because they asked me for information in October. It was mid-October, and I got it to them the next day, uploaded it into their platform, and the day before closing, they were asking me about items, and I said, it's in your platform. I've uploaded. And she goes, what do you mean by that? They didn't know anything. They didn't even know what they were looking at. So anyway, they weren't you anyway. So, okay. So,
Vic, let me interject that just real quick, something with that.
Sure.
Being said, that's why you have to go with a loan officer that has many years of experience and is knowledgeable. And what we want to do is make the easiest transition, it's the transition from the beginning onset of the qualification to the closing.
Mhm.
Okay, you don't want any surprises, last minute surprises. It's stressful enough, man. You know what I mean? So we ask for everything pretty much up front. Now, full transparency, underwriters might come up with something along the way that you have to, appease them with. And the quicker that the client can get the documents to us, the quicker we get it to the underwriter. It's not like a split second thing. You give it to the underwriter and it's done. Typically, a condition is what they call. You give it to the underwriter. It could take 24, 48 hours for them to clear that condition.
Okay.
So, when it comes down to the actual transaction, we try to get everything up front. Boom. So we're not bothering the borrower or the realtor along the way. Hey, I need this on a Monday. And you call back on Wednesday. I need this. No, we're gonna cross all our T's, dot all our I's, get everything up front. There's could be some things that come up that are out of our control that we have to appease the underwriter with. But yeah, no one likes that last minute stuff. It's a big headache and it's very stressful.
Appraisals. Who orders them and what happens if they don't appraise? Now, for those of you who are watching, if a house is selling at $400,000, the lender has to make sure it's worth $400,000. What happens if the appraiser, which is hired by the lender, says it's not worth $400,000?
Okay. Yeah, that happens occasionally. Basically the wholesale lender orders the appraisal through what's called an appraisal management company. Okay. They're their own entity. All right. If an appraisal comes, I did some dental work today, so I'm a little, anyway, but, it might be slurring a little bit. But
you're not drunk. Okay.
No.
Anyway,
but no, if an appraisal comes in egregiously low, like an appraisal might come in $3,000, $4,000, $5,000 low, that's something that can be negotiated between the seller and the listing agent and the buyer's agent. But if something comes in egregiously low, we can do what's called a rebuttal on the appraisal. We can come up with other comps, whether from the listing realtor or the buyer realtor or ourselves, and then resubmit that in to the appraisal management company to take a look at it and see if they can make those adjustments. I've had it where they can't, and we order a new appraisal, okay, through the appraisal management company, and if that appraisal comes in at value or where we need it to be for the sales price, then the other one will be thrown out. All right. So it's not like the actual lender has any say in what the value is going to be of the appraisal. It's through the appraisal management company, but our hands on the pulse of that. And like I said, there's ways around that. The best thing to do is make sure that on the onset of the purchase price, make sure that it's realistic to what the market value is. And then you don't have to really worry about
that's one thing, I always say people who are paying cash, they really need to look at the comps because there's not going to be any appraisal in there. So when you pay cash, so you really have to look at the comps too to know beforehand if you're getting the right deal. But I will tell you that thing that I always thought was interesting about appraisals is that the appraiser seems to know exactly how much this house is selling for, which I think is kind of weird. It's like, okay, the house is selling for $400,000 and miraculously this house appraises at $400,000 and, nothing more. And I find that that's like sort of, I'd rather know what it's really worth, but that's because a lot of people, and I've heard this happen, have said, oh, I thought I was getting a really good deal. Why is it only at $400,000 if it's, if it's really worth more than that? And luckily it hasn't happened too much with me, but we usually praise and everything's okay. But I think that, this is a great question from Florida, man. So we'll skip the next question. So anyway, is the interest rate higher for out-of-state buyers purchasing a second home good. That segues into the other question that I had.
Yeah, second homes are typically the interest rates are going to be higher. Okay, because it's basically, it's a second lien position basically, and that's why they require more money down too. On a second home, it's like I mentioned earlier, it's 10% down. Investment property 20% down. Investment property, but the interest rates typically on second homes and investment properties are basically around the same. Okay, depending on how much you're putting down. Like I mentioned earlier, the more you put down, the lower the interest rate's going to be, as long as your credit's where it needs to be. But yeah, on second homes, right now, well, actually interest rates have been creeping down, but on second homes, you can look at an interest rate, 7.5%, basically. Let's just put that as a standard, and same as an investment property. Okay. Yeah. Because look at it this way. If you're going to come into some type of hardship, which house are you going to let go first?
Yep.
Second home. You're not going to, so that's why the interest is a little bit higher, because it's a little bit higher risk for the lender.
Yeah, and that's why there were so many foreclosures in this area where they were second homes and investment properties. Right. In, like, for example, Davenport, there were tons of investment properties that they just gave them back to the bank. So I haven't seen that. I used to sell nothing but foreclosures for the first 5 years I was doing real estate. And then since then, I haven't had anything since then, which is good for us and good for people. So
very much so.
Yeah. So, okay. So we're going to ask another question here. Now, I'm going to say that change, that it's more a higher interest rate for second homes, that's more recent, right? Because I don't remember that being the way when I bought my second home.
Yep, that's correct. And let me tell you the reason for that. All right. And you're right, Vic. It's been recent. It's probably been about 4 years or so.
I would say that sounds right.
Yeah. And what happened was that people, manipulating the system, so to speak, were purchasing second homes, okay, with the full intention of renting them out.
Yes.
Okay. Which is mortgage fraud. Okay. So
it is.
Fannie Mae and Freddie Mac kind of got wise to this, because you can't, audit every home, so to speak, that's purchased. But they made the interest rates roughly the same with the investment property in the second home because of that reason.
Yeah.
So that way, if you're going to buy a second home, it's you're not going to, because before, second homes, the interest rates were exactly the same as primary residences, but then people were manipulating the system, and that's why they raised the interest rates on second homes.
And that's the influx of Airbnb and VRBO and all that.
Yeah.
Yeah. So, yeah.
Important.
Okay. What's the smallest, simplest change someone could make that might improve their mortgage rate? Okay.
Okay. Yeah, that's a good one. That's a good question. Well, like we touched on earlier, your credit. Okay. Let's make sure we keep those balances under 30%. Let's make sure that we don't all of a sudden go on a shopping spree before you want to buy your home. Okay.
Yes.
Let's make sure we're not late on anything. Okay. That is, like I said, typically those three things are going to be the biggest impact on getting your credit scores up to where they need to be. Okay. The one thing I will say is I've had a lot of people come to me that feel distraught because their credit scores are in the low 500s or high 400s. Hey, life gets in the way. All right. Yeah. I've been working with a credit repair company for many, many, many years, and they look at the easiest way to improve your credit scores with the least amount that you have to do. Okay. Now, of course, the client has to be proactive. Okay. They have to follow what they're supposed to do, or nothing's going to change. All right. And what I've done, just to segue into this real quick, I've instituted this with my company here, is that let's say somebody has that credit score that needs to go up, their credit profile needs to improve. I set them up with our credit repair company, consultation wise. I think it's like $85-$90 a month that they have to pay to the credit repair. And there's lots of these stories of this, these credit repair companies that are up to no good, so to speak. Okay, suspect. But the ones I use are I vouch for them. But you get your credit scores up. It might take you 3, 4, 5 months, depending on how damaged your credit is. We get your scores up through the credit repair company to a point where you can qualify for a mortgage. You close on the home. What we'll do at Home Lender here is that we will give you a lender credit for whatever it costs you to fix your credit, like, 3 months that you do it. So at closing, we'll give you that lender credit. So we're going to improve your credit and get you into a home, and you didn't have to pay for your credit repair.
Here's a question that came in. How do lenders actually decide how much someone can afford?
Well, that's simple. Here's how that works. Okay, it's all about whatever income that we can use. Okay, if you're a W-2 employee, it's what will you make monthly? Okay, through your income. All right, and then we divide that by what's on your credit, the minimal payments that you need to make. Okay, on your credit cards, installment loans, car loan. We add that to the proposed housing payment. Okay, that's your principal, interest, taxes, and insurance. If there's an HOA on the property,
I'm just gonna say,
EDD, right? We add all that together with what's on your minimal amount that you owe or you're obligated to pay monthly, and then we divide that by your income. Okay, and that's what's called the debt to income ratio.
Yep.
All right. For FHA loans, VA loans, we got to keep that under 55%, and conventional loans under 50%. Okay. So that determines what your maximum that you can qualify for. Now, does that mean that's the house that you're going to want to, if you can, you're pre-approved for a $400,000 home, but you only want to pay $1,800 a month for your mortgage? Well, then you know what? You're not looking, like we touched on in the beginning of this, you're not going to be looking for that $400,000 home. That's what you're approved for. But if you're more comfortable paying a lower monthly payment, then you got to look for a purchase price that's lower than that. But that's pretty much how that ratio, the debt to income ratio, that's what we basically look at to see what you qualify for. Okay, when it comes down to that. When we go ahead, Vic. I'm sorry.
And if you did something foolish, like buy a car right before closing, I've had people whose cars have been breaking down, and I've told them, rent a car
Yeah.
until you close, because when you get that payment shows up on your debts, it's going to totally throw off all your figures there. So
that's correct. That's correct. Just be after, and I tell the clients, after I get this pre-approval letter out, don't have anybody pull your credit. Don't go shopping. Don't maximize anything on your credit cards. Don't do anything at all until you close. And then you can do whatever you want to do.
Hey, I've got a question here. Does housing assistance can help with your housing? I'm sorry, I don't totally understand that, but
I think they're maybe talking about down payment assistance. Here,
okay.
Yeah, there's lots of programs. A lot of lenders that we work with have grants that you don't have to pay back, when it comes to that.
No, I didn't get one.
Yeah, we do have that option. There is down payment assistance. You can go through whatever county, and here's how that works. You go to, let's say you wanted to buy in Orange County, right here. Okay, you got to go Orange County website. Let's see if there's any funds available, number one. Get a pre-approval letter from a lender, and then you have to apply through that county separately. Okay. It could be somewhat time consuming, but that's always an option. And then there's also a program coming out the 18th. It's actually available now. I just got a notification. It's called Hometown Heroes. All right. And that what that is, it's Florida based. It's only for first time home buyers. Okay. And a first time home buyer, Vic, strangely enough, is not just someone that's never bought a primary residence. It's someone that hasn't owned a primary residence in the last 3 years. They're considered a first-time home buyer. Okay. Mm-hmm. And a veteran. Okay. A veteran, and we love our veterans. There's no doubt about that. Thank you so much, guys out there, that you don't have to be a first-time home buyer for this Hometown Heroes program. It goes by occupations, teachers, anybody in the medical field, veterans, first responders. They're offering 5%, okay, towards your closing costs and down payment, okay, wow. And that helps immensely. And right now, with that being said, it being such a buyer's market down here, meaning so much inventory on the market, so many houses out there, that we're seeing a lot of seller concessions to the sellers because of so many homes out there. The sellers are trying to make it more attractive for the buyer to buy their home. So they're offering some money to help out the buyer, not just some, $8,000, $10,000, $12,000 in a lot of cases to help the buyer with their closing costs. So between a down payment assistance program, the seller concessions, and don't forget the gift funds, guys. All right. Between that, you can a lot of times come out into a home with nothing out of your own pocket.
No, it's never happened to me, that's for sure. Okay, so let's see if we got one or two more questions here before we sign off. How about this one? What's a mortgage myth you wish would disappear forever?
Okay, well, mortgage myth. That's a good question. That I wish would disappear forever.
It can't be all good.
No, I know. I would say the biggest myth is that, oh my God, I have to put 20% down on a home.
Yes.
Okay, that's out there. Oh my, I don't have the money. The biggest myth is that, especially for first-time home buyers, how do I even do this? It's so overwhelming. It's so crazy. Listen, guys, only thing you do is get an application filled out. It's 3 pages. You can do it online. The only documents that we need as a lender, basically, to get you pre-approved is your last 30 days pay stubs, your last 2 years W-2s. And, if you're going to be coming with your own assets out of pocket, then a couple of months bank statements just to show that where the money's coming from. That way we get that pre-approval letter out. We have to run your credit, the bottom, full transparency. And then we get that pre-approval letter out to Vic, and then Vic takes you shopping for homes.
What are some mistakes that people make other than buying something expensive that might put a wrench into buying a home?
A lot of the stuff we already touched on,
Okay.
Doing something with their credit, prior to closing, being late on something, purchasing something, large deposits in your bank account. I'm glad that you mentioned that. Like you touched on earlier about when the underwriter was asking for things with your loan, Vic, is that everything has to show a paper trail. Okay. Yes. There's a thing called mattress money that people think, okay, I've got $50,000 in cash at my house in my safe. The first thing I ask in that situation is, when are you going out of town? I'm just kidding. They're going
to ask where you got that.
Because
if you put let's say I put $20,000 towards my house as the initial payment, they're going to want to see the paper trail of where that came from, because they want to make sure that you don't owe somebody for that.
Right. That's correct. They want to know where that paper trail is. And simply that's just a bank statement, a receipt. A lot of people use, another thing for down payment money is how they sell a car, or they sell their motorcycle or their boat. Yep. You can use that money, but you're right. The paper trail, need to see the sales receipt for it. So everything kind of has to be backed up that way.
Yeah. It's a totally different world when you pay cash, I'll tell you. I mean, there's nothing easier than buying a house cash. But the thing is, if you don't talk to your lender first, all these things are going to be coming at you at the last minute. So that's why it's so important to develop a relationship with a lender before you before you start looking at houses. Because I've had people say to me, oh, I've got, this is my budget. And I'm like, well, are you paying cash? Well, then that's not your budget. You need to talk to a lender first to get an idea of what your budget is. So
correct. And even if, you don't have to buy a property all the way out cash. You know what I mean? You don't want to, if some, don't want to leave yourself strapped. You want to leave some assets for yourself. You know what? Get a small mortgage, put more money down. It's going to help your monthly payment, and then you can always pay that off in the future, the
Sure.
whole mortgage, and then you're not obligated to it anymore.
Yeah. Florida Man is asking if there's any wire transfer safety tips. I'll answer this first. Always verify by a phone call the person that you are wiring, that is requesting this wire. So it's usually the title company. So just call them up and get a relationship with the title company. So if the person's name is my title company's lady name is Stacy, make sure you talk to Stacy. Don't talk to someone with an accent that doesn't sound like Stacy, because I've had one of my customers got an email asking for the $300,000 that was due, and it looked suspicious, and they called and it was fraud. So always make that personal connection so it's not a surprise when you call. Do you have any suggestions on that?
Yeah, they've come a long way with that. I mean, wire fraud's a big thing. So what they'll do is that you contact your title company, or whoever the seller chooses as the title company. All right. You'll contact Stacy there, and she'll give individual wiring instructions to how or to wire the money. And those individual wiring instructions are just for that particular client at that particular time. So they've come a long way. I haven't heard of anything fraudulent because with the wiring instructions and going straight to the title company, it kind of took that whole thing out of the equation.
Yeah, a lot of title companies now have portals, so you have to create your own identity to get into the portal. Let me see. Phil's asking a question. This will be our last question. If you own a home and have parents, for example, that have a lifetime rights to the home, will that disqualify you from a first-time home buyer's grant? Ooh, good question.
So let me get straight. So if you own a home and have parents that have lifetime rights to the home. So Phil, are you on the deed and title of this home?
Let's assume he is.
Okay, because deed and title, if you're on the deed and title, that shows ownership. So you wouldn't be a first-time homebuyer. Okay. Okay, so you'd have in that case, if you're on the deed and title, which shows ownership, you wouldn't be considered a first-time home buyer in that situation.
Okay. All right. But so that would mean he'd have to go for a more conventional loan, which is called a conventional loan. And how much would he have to put down?
Okay.
But he already has this home.
Okay.
So, and I'm assuming he doesn't have any debt on this home.
Okay. Well, it depends on what the other home that he wants to buy as a primary residence. That's fine. With FHA, it's 3.5% down. Conventional would be 5% down. VA loan, 100% down. What you can do is you can purchase the other home with that percentage down, and then you can actually lease out the current home you're in if you choose to, and it won't count against your debt to income ratio either. You can wash that payment out if you do have a mortgage on it, with a lease agreement. But to answer your question, Phil,
Lease agreement. Okay.
yeah, if you're on the deed and title, that shows ownership, so you wouldn't be considered a first-time home buyer.
Okay. Well, this was great. Went by really quick. So if you do have any questions, there is Todd's contact information. Write down his cell and text number, also his email address and his website. So if you just reach out to Todd, Todd's a broker. He deals with a bunch of different companies to find the right loan for you, which I think is a much more effective way of doing it than walking into a bank and only having one option. So anyway, Todd, thank you so much for watching today. I really appreciate it. Before we close off, I'm going to show a video of my current listing. And if you want a loan for it, call Todd. Thanks again, Todd. I appreciate it.
My pleasure, guys. And listen, the best way to get a hold of me is my cell phone number. And I'm always available.
Okay.
Just text me first and we'll go from there.
It's
Vic,
right on screen.
Thank you very much, Vic, for everything that you do for the community. You're outstanding. And it's a pleasure to work with you. And very modest.
Yes.
Okay.
Okay.
Have a good night, guys.
Thanks, Todd. I appreciate it. Okay, everybody, I'm just going to play the quick video of my recent listing, and then we'll sign off. And I'll leave Todd. Thank you all for watching today. I really appreciate it. That home is available if you're interested. Please reach out. It's an over 55 community. And I'm Victor Naraki. I'm hopefully your realtor of choice. And if you have any questions for me or Todd, please reach out. Thank you so much for watching today, and I'll see you soon. I am not doing a live stream this Sunday, but I will be back next Sunday, and I hope to be in Groveland.
Making the dream of a Disney lifestyle a reality. I'm Victor Naraki. Contact me on Facebook at Naraki Realtor or my website, celebratingflorida.com. Thanks for watching Disney at your doorstep.